Are you in a situation where you want to start investing, you've got some extra cash ready and waiting to invest into the stock market, but all you see is the stock market all-time highs and speculation that it's in bubble territory? Do you hold on for the crash to occur, or do you invest now in the hope that the market continues to go up in value? These are the exact thoughts in which I've had for myself personally, and it's partially the reason why I've been holding a little bit more cash in my trading 2-on-2 investment portfolio, because it's a conflicting situation where you've got companies like Morgan Stanley who have said that a 10 to 20% market correction is ahead, but then in the next breath you've got some analysts who are saying we could see another 5 years of a bull market. So what exactly do you do? Sit out of the stock market twiddling your thumbs waiting for an opportunity, or do you take the plunge and go all in now? Well, that's what we're going to discuss during today's video. We're going to take a look at some historical data as well as listen to some wise words from one of the greatest investors to ever walk the planet. But before we do so, guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below, so I'll drop a like on the video, guys. Really helps out the channel. And with that being said, let's dive straight into it. Now, before we dive into the content, guys, be sure to let me know down in the comment section below what investing questions or queries that you guys all have, because the more questions in which you ask, the better, or the more it helps me actually create content specifically for you guys, because if I know the kind of topics that you guys want to hear about, and hopefully it will allow me to create better videos for you. So having said that, let's talk about the dilemma of holding cash ready for the crash versus investing into the market now and hoping that it goes up in value. To get the best answer to this question, we're obviously going to have to take a little bit of a look back in history, take a look at some historical data and historical performance in order to best inform us in order to make the best investment decisions. Now, throughout this video, I'm going to be using and referring to the S&P 500 index as an example. The reason being, it's largely the preferred market to invest into, and for me personally, it's certainly the preferred investment choice of mine, having quite a large holding of a Vanguard S&P 500 ETF in my investment portfolio. So first up, let's talk about the stock market, and let's firstly define two of the common terms that are used when we're referring to a stock market selling off. So firstly, we have a stock market correction, which is whereby the stock market sells off between 10% and 19.9%. And the second term is a bear market, whereby the stock market sells off 20% or more. But how many market corrections and bear markets have we seen for the S&P 500 over the course of history? Well, let me share you guys the numbers in order to bring it to life for you. So looking at the period between 2008 and 2021, we've seen in total 6 market corrections and 2 bear markets. So that's 8 times in the past 13 years in which we've seen the stock market significantly sell off. Meaning on average every 19.5 months you can expect to see the stock market sell off at least 10%. But roughly every 6.5 years you can expect the stock market to sell off 20% or more. And whilst we're obviously looking at quite recent historical data over the course of the past 13 years or so, the numbers aren't exactly massively different from when we look at the stock market over the course of the past 90 years, because from 1932 the data suggests that bear markets take place every 4 years and 8 months. So in actual fact, based on most recent market data, bull markets are actually lasting longer than ever before. And one of the primary reasons for that is because we've most recently experienced the longest bull run in history between 2008 and 2020. So being only 1 year and 4 months into the current bull market in which we're in, despite the fact that we're obviously trading at all-time highs and there's obviously lots of speculation about the market being in a bubble, we are, based on historical averages, very much still a little bit early on in this current market cycle in order to actually see a bear market playing out anytime soon. But a correction, on the other hand, based on these historical averages, well, we could only be about 3 months away from the next market correction between 10 and 19.9%. So it certainly brings into question whether you should actually be holding a significant amount of cash now, ready and waiting to invest into the market when the next market correction or bear market occurs, or will you end up actually losing out because you will have lost out on the potential gains from bull markets which are lasting longer than they ever have done before. Well, we know now how regular market sell-offs occur, so now let's take a look at the average gains during a bull market versus that of the average losses during a bear market. Well, to give you guys the numbers, the average loss in a bear market is 36.34%, but the average gain during a bull market is 180.04%. And with 90% gains into the current market cycle in which we're in, based on historical market cycles, we've still potentially got about another 90% worth of upside to be priced in just yet. And this is where I think I'll bring in a quote from the legendary investor Peter Lynch.
I mean, the stock market's a very good place to be, but I can toss a coin now. Is it going to be lower 2 years from now? Higher? I don't know. More people lost money waiting for corrections and anticipating corrections than the actual corrections.
And I guess this couldn't be more true. If the potential upside is 180%, but the downside is only about 36%, and that's in a bear market, of course, not just a market correction, so we're kind of assuming a little bit of the worst case scenario, well, you don't exactly need to be a rocket scientist to work out that you're probably going to be better off investing into the market than not. And to bring this all to life, let's apply some of the numbers and apply some of the historical market averages to today's current market prices. So if we assume a 180% market gain from the market lows of 2020 to assume the next leg of the bull market, the S&P 500 would trade at 8,350 points. Then if we assume a 36% bear market thereafter, the S&P 500 would fall to 5,350 points. But if you'd invested today, despite such a huge sell-off in the future, your portfolio would still be up just under 22%. Now appreciate we're obviously making some pretty bold assumptions about what could potentially happen based on some historical market averages, but based on the data and all of the data in which I've looked at, it certainly looks like you'd be better off investing into the market today and capitalizing from the future upside potential rather than waiting out for a market correction or even a bear market to occur. Now, in support of this, over the course of the past 91 years of market history, bear markets have occurred in only about 20.6 of those years, meaning stocks on average have been on the rise 78% of the time. So I guess you could say if you'd invested into the S&P 500 today, you also have a 78% chance that the S&P 500 will continue to rise in value tomorrow too. Now, if you're not quite convinced about the data in which I've presented at this point in the video, and you're possibly thinking to yourself, well, I could probably time the market a little bit better than the average investor, I could possibly even look to sell off at the peak of the market and buy back in at the lows of the market, well, I'm going to caveat that by saying it's an extremely difficult thing to time the market, and looking at the following statistics may just change your mind about looking to time the market versus that of just simply investing and holding it out instead. 56% of the S&P 500 index's strongest days in the last 20 years have actually occurred during a bear market. But what does this mean, and how will it actually affect your investment portfolio and your long-term performance over time? Well, between 1999 and 2018, if you'd missed just the 10 best days of market performance, your annualized returns would be just 2.01%. If you missed the best 20 days, you'd make a small loss of 0.33%. If you missed the best 30 days, you'd be down 2.35%. The best 40 days, you'd be down 4.2%. And the best 50 days, you'd be down 5.87%. But the best 60 days, you'd be down 7.4% per year. Now, if you consider the average annualized rate of return during that period of time was 5.62%, missing out on just a few weeks worth of the best performing days in the stock market during that period of time could severely hurt your long-term investment performance. It's literally the difference between being able to successfully grow and compound your investment portfolio over the course of the next 5, 10, 15 or 20 years versus that of losing money hand over fist, which kind of goes to suggest that the best way to weather out a storm in the stock market is to simply stay invested. But don't take it from me, let's take a listen to what Peter Lynch has to say instead.
Longer term, stock market's been the best place to be last 10 years, last 30 years, last 130 years. But if you need the money in 1 or 2 years, you shouldn't be buying stocks.
So as Lynch says, one of the best places to invest your money, especially if you're investing for the long term, is simply to invest in equity markets. The only real caveat being is if you need the funds in which you'd plan to invest over the course of the short term, for example, over the course of the next year or two. In which case, it's probably not worthwhile the risk investing into the market just in case a bear market actually occurs. But if you're a long-term investor, based on all of the research in which I've done preparing for this video, for the average investor, the chances are you're probably just going to be better off staying invested into the market and holding it out for the long term. So I hope this video kind of dispels some of the fear and uncertainty about investing into the market today at all-time highs. And of course, it's probably worthwhile me saying, as always with these kinds of videos, when we do look at historical data and historical performance, is not always indicative of what's going to happen in the future as well. But be sure to let me know your thoughts down in the comment section below, guys, as well. As I said at the top of the video, be sure to let me know any topics, any investing questions or queries in which you may have, in which I could potentially look to create a video on at a later point in time. And if you enjoyed the video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.